So let's just get on with it. I met with most of you at the beginning of the week and had you mark up this chart, which, as I kind of revealed, is a chart of 1,000 coin flips. So it's totally random, and yet, as most of you observed, the levels here are so clean. They appear to have some meaning or significance. But the reason I started by showing this chart is because I see a lot of people drawing and trading basically random shite. Okay, levels which have no meaning to the market. You'll quickly find out, if you draw a line almost anywhere on your chart, you'll find significance or what appears to be some meaningful interaction there. And that's just how we operate. We're kind of wired in that way to seek out patterns. So for me, it's really important to find a way out of trading what are often essentially random levels. And the way out, I think, is to develop an understanding of liquidity dynamics. In other words, why exactly does the market move, and how should you expect it to move given certain conditions? Okay, so how does price move? You might have heard this thing that the market goes up when there are more buyers than sellers and down when there are more sellers than buyers, but this just isn't true. That the market's it's a mechanism for matching buyers with sellers. So whatever the instrument, whether it be Bitcoin or gold, whatever it is, number of export equals number of Y sold. Okay, so price moves up and down as a result of the ratio of market to limit orders at any given price. So, of course, with an even number of market buys and sells, price will push to the less liquid side of the market. And this was really well expressed by Chris Laurie, who I've learned quite a lot from. He said that volatility is a function of liquidity. Okay, and that's really important to remember. So we're just going to go over some basic stuff first, and I don't know. We've got kind of a mixed group here. So for some of you, the next few minutes might seem like really basic stuff, but it's important that we cover it just so that everyone's on kind of the same page. So to give you a better idea of what this looks like, what I'm talking about, I'm just going to go over the depth of market or DOM. So this is just an order book, but before I start, I should just make it clear that price is fractal. Okay, and we'll cover this in a lot more detail later on in the program, but this just means that price behaves in a similar manner on all time frames. So the order flow dynamics which govern how price moves and which can be kind of observed at the lowest level in the order book or depth of market. When I say that price is fractal, I just mean that these dynamics also play out on all other time frames. So I start with this because it's really worth our while spending some time on observing the dynamics at the lowest level. Okay, the mechanism through which price moves, because it will, I think, help you visualize what's going on when you're observing price action on the higher time frames. So you've all seen an order book before. This here on the left is the buy side, and on the right is the sell side. So you can see exactly how many dollars worth of Bitcoin in this case is waiting to be sold at each price level. So down here, these are your limit buys and these are your limit sells. And for the most part, they're not just kind of static. They're not just sitting in the book waiting to be filled. But cryptocurrency, especially, tends to have a relatively static order book compared to other markets. Anyway, that's a little bit of a tangent, but I'll get into more detail about that later on. The point is that you know, what you see here is orders sitting in the book waiting to get filled, and that's what you're seeing is liquidity. Okay, orders in the book waiting to get filled, and this here is the spread. Okay, denoted by the orange boxes, the difference between the best bid, which is the highest price at which someone is currently willing to buy, in this case 8165.5, and the best offer, so the lowest price at which someone's currently willing to sell, 8166. And you know, sometimes the spread is quite wide, but you know, this is a BitMEX order book, and in this case it's fairly tight, at least on Bitcoin, and you can see here it's currently $0.5, half a dollar, but that will of course change depending on how price is moving. Okay, so this is the mechanism through which the market moves, and what you're, as I say, what you're looking at here is liquidity, limit orders in the book. You might have seen this a lot on Twitter, but liquidity does not equal stops. Okay, stops are converted into market orders for the most part when they hit, and they eat up limit orders. They consume liquidity. So while, you know, limit orders are considered passive because they just kind of sit in the book waiting to get filled, market orders are generally considered to be more aggressive. And this is basically because, you know, if I'm a kind of impatient trader, if I want in now, I have to pay the cost of the spread to get in the market. Okay, so if I want to buy now, I'm buying into the liquidity on the best offer, so I have to pay the cost of the spread, and I'm effectively paying up for my impatience. So, you know, if I want to market buy right now, I have to buy into or consume the liquidity on the sell side, and when I do that, I'm essentially paying up. I'm crossing the spread to get in as soon as possible, rather than waiting on the bid here and kind of hoping that I get a fill. And, you know, similarly, if I'm an impatient seller, I'd be selling into the best bid here. And again, the cost of that impatience is the spread, and of course the spread isn't always this tight. Often it will be quite wide, and traders are still willing to cross it, and sometimes forced to cross it, and that's important. Anyway, I'm going off on a bit of a tangent here. The point I really want to make is this. Let's just clear this. If I wanted to buy, let's say $3 million worth of Bitcoin right now, I would be pushing the price up to, you know, somewhere up here. Okay. So if I market buy a large amount of Bitcoin, I'm consuming all of this sell side liquidity. And, you know, if I do that, if I push price up to, let's say 8172, what's on the sell side here in terms of liquidity? Bid side, I mean, what's on the bid side? Well, there's nothing. There's a void there, and that void takes time to repopulate. So, you know, what have we got? We've got, well, there's still liquidity here, but there's no liquidity in there. And because, you know, as I explained at the start of the webinar, prices move up and down as a result of the ratio of market to limit orders. Unless a load of limit buyers step in here, price is going to move back through this area with relative ease. Okay, price will push to the less liquid side of the market. Is that all clear? Apologies if it's a little basic. We're just kind of laying some groundwork here. as I say, if you've got any questions, just jump in on the chat and I'm happy to answer them. Okay, so this is the mechanism through which price moves, and which is at the core of the principles I'll be teaching over the next few months. And I want to kind of show you this and spend a little bit of time on this, because traditional models pay little attention to how trading actually takes place. The kind of assumption being that the details of trading, or market microstructure being the mechanics of how the decisions of traders are kind of filtered through the market. Okay, so traditional models make the assumption that these details are unimportant for the behavior of price, especially over longer time frames like months or years. But in fact, what's emerged in more recent kind of research is that the mechanics of trading are an integral part of the process through which prices are determined across all time frames. Basically, according to standard models, the main force behind price must be news, or more specifically, news which has implications for the fundamental value of whatever it is you're trading. And macroeconomics fundamentals by no means my strong suit, but let's just say that the price of a commodity like oil or gold, for example, will be largely determined by cash market supply and demand, whereas the price of stocks might be affected by stuff like the value of the company's resources, technologies, supply and demand conditions in the market for whatever product it is, Apple, for example. And the prices of currencies are influenced by things like inflation, changes to macroeconomic policy, trade flows, the rest of it. But the point is, whatever the instrument is, and this is so important, expected changes in fundamental factors don't generally have an impact on prices. So they've already been priced in. And so when news is released, when news comes out, it's not surprising, and therefore it shouldn't cause prices to change. Does that make sense? So you'll usually you usually get some kind of short-term volatility around announcements, and that's because liquidity providers are guarding themselves against the unexpected by temporarily withdrawing liquidity from the market. So just for example, this is a 5-minute chart of Euro USD, I think from April, and it was when NFP numbers came out, and you can see that this is when the numbers came out. Although there was a short burst of volatility relative to the kind of price action you had before the announcement, the news didn't really have any meaningful impact on price. Okay, so short burst of volatility, it does sell off a bit, but then nothing major here. And that's because the numbers were more or less forecast accurately. Okay, they were expected. Anyway, the point is that generally prices will only be seriously impacted by unexpected events. Okay, and one nice example, I don't know if any of you follow oil, but there was a drone attack a few months back. I don't know too much about it, but as far as I'm aware, it was an attack on Saudi Arabian oil facilities, which at the time could have had very serious impact on the oil market, and as a result, oil prices spiked. And I've got a chart here. I think this is actually the biggest jump in global oil price since the 80s, so a relatively massive move here. Okay. Anyway, the point is that it's unexpected events which generally cause volatility, and which tend to precede these large jumps in price. And so the question is, if volatility is determined by the unexpected, how can we possibly make money trading? Because we don't have a clue, or I certainly don't have a clue what the fundamental value of a Bitcoin is, for example. Such a thing even exists. So as kind of uninformed, or what some people call noise traders, which I think is quite a funny term, how are we meant to trade? And for me, this is where an understanding of order flow dynamics comes into it. It's so important to remember that the market is not efficient. Going back to what I was saying earlier, the very mechanism which enables traders to kind of express their views on the market, so which allows you and me to buy or sell, mechanism through which price kind of finds value or finds the price at which participants or the market thinks it should be trading. That mechanism also distorts price. So market microstructure, the process by which price moves or finds value, that mechanism itself is also responsible, at least in part, for actually driving price. So in other words, volatility isn't just a reflection of value, whatever that means. It's at least in part a result of the fact that the market is inefficient, and it's this inefficiency which allows us to make money. Okay, I hope that's all relatively clear so far. If not, it should become more clear as we progress, because I've got some more kind of practical examples. So for me, it's really important. This is a Bitcoin chart, by the way, hourly from a few months back. It's really important to understand that a move like this here is not necessarily a sign of kind of abnormal or anomalous volume. And even if it is, an absence of bids, or in this case offers, okay, an absence of offers can kind of spread price as it reaches for available liquidity. And it's this lack of or absence of liquidity which causes a move like this to kind of overextend itself. So very often, especially in illiquid markets, it's not volume, it's not an influx of buyers or sellers which causes moves like these, but an absence of liquidity, okay, an absence of orders in the book. And of course, very often it's market structure which acts as a trigger for these inefficient price runs. And what happens is, price will either catch a liquidity void and or concentrated stops at levels like this, for example, above each of these highs. Market participants would have had stops, and those stops are of course converted into market orders which consume sell side liquidity. You've also got the fact that because information about stops isn't public, okay, we can kind of guess where they might be, but we don't know how big they are, if they're even there at all, because that information is not public. And to be honest, because a lot of traders are just uninformed, what people think is kind of rational trading by uninformed traders like you and me essentially can also intensify these moves. So when price starts moving quickly, traders jump in on the back of momentum. And when price starts moving, traders are forced to make decisions. So a move like this will attract the interest of traders who rush to buy or sell. And that's the reason you get overload on BitMEX. There are just too many people trying to trade when price starts moving quickly. And all of this kind of dynamic is exacerbated by market makers who will widen their spreads as price starts moving quickly like this. In fact, I'm going to quickly talk a little bit about market making because there's a lot of confusion, and I'm by no means an expert, but this is my very basic understanding. So there's demand for immediacy, right? If you want to buy at market, generally you want to buy at or near the current price, okay? And market makers supply this immediacy. The market's not perfect, okay? And so, you know, there's not always someone wanting to take the other side of your trade at the price you want. And so, yeah, market makers supply that immediacy. They sit on the bid or on the offer or both, and they kind of take on risk on behalf of traders until they can find a counterparty. So as price moves up and down, they're effectively kind of capturing the spread between the bid and the offer. So you know, let's say price is kind of trading up and down. Let's say the range is $1. Okay, the price is trading between 100 and 101. Okay, in this scenario, a market maker is happy. Okay, they're quite happy to sit on the bid or the offer or both and kind of make profit on the spread all day. However, you know, more often than not, price is moving in a much wider range, and the market maker will kind of capture the spread over time. All right, and so if the market's moving up, market makers are going to be short at higher and higher prices, and as the price moves down, they'll unload that position, kind of capturing the spread as they go. And so they're not totally passive. You know, they're not manipulating the market, but they're not totally passive because they're here to make money. So if the market's too volatile, if it's moving too quickly or too far, too fast, what they'll do is withdraw liquidity from the market. So they'll widen the spread. So think about it like this. What happens when, let's say, they're sitting on the offer at 101 and they're offering 1 million, okay? And, you know, 10 million buy order comes in and price starts moving very quickly. Does a market maker want to be selling down here when there's quite clearly demand and prices beginning to surge? Well, no, because they'd be accumulating a short position at the worst possible time. That time being, you know, when price is moving quickly and is therefore kind of vulnerable to stop cascades and or a fast or momentum move. So what does he or she do? They'll either stop providing liquidity altogether. So they'll pull the offer, or they'll dramatically widen the spread. So instead of offering 101, they'll offer 110, for example. Obviously a very basic example, but this is just to demonstrate the principle here. And this is so that anyone wanting to get in on the move, you know, anyone wanting to buy here, they have to pay up, they have to pay a premium. Okay. And it's this lack of or absence of liquidity, which is one of the things that fuels sharp or violent moves. Okay, because when there's a fast move, or you know, there's a surge of demand, liquidity in the immediate vicinity of price is basically withdrawn from the market, and as a result, price has to start kind of jumping to find counterparties. Does that make sense? So all I'm trying to demonstrate here is the idea that there are certain times when liquidity becomes very thin as a result of the way in which price is moving, and part of the reason that happens is because market makers will widen the spread. And this is one of the reasons why price tends to overshoot. So inefficient price moves aren't always caused by an increase in buying or selling, an increase in volume. In fact, more often than not, they're caused or at least exaggerated by a lack of or absence of liquidity, through which price can move quite easily. Okay. So let's say you've got some period of consolidation, price breaks out. Okay. When you get a move like that, there's an imbalance, and price accelerates there because, as I just mentioned, market makers will reprice, they'll widen the spread, or they'll stop providing liquidity. Traders getting stopped out, okay, stops which are converted into market orders, which are consuming sell-side liquidity, and you've got traders who are jumping in on the back of momentum, okay, so breakout trading. And it's the force of all these participants combined with an absence of liquidity, which can cause a kind of bubble in which, you know, price will essentially kind of exceed its fundamental value. Price will overshoot, and this happens on every time frame. As price moves out of balance, price has to start jumping to find counterparties, and it's that jumping or stretching or reaching for liquidity which kind of leaves in its wake a void in liquidity. This should become a little bit more clear as we progress, but I hope you all kind of understand that principle. So a fast or violent or illiquid move like that will very often leave a void or vacuum in its wake. Apologies for the shitty illustration, but I've got some actual examples coming up. One interesting note: momentum ignition algorithms are kind of designed to take advantage of this behavior. That's effectively what the quote unquote BART pattern is for those of you who are familiar with or trade Bitcoin. So when price jumps, algos will quickly change their bid-ask quotes. The spread will immediately widen, and there's a kind of knock-on effect, just as I've described, whereby momentum traders jump in, price overshoots. And so if you can detect an area in which, you know, liquidity is relatively thin, what's happening here for the most part is that people are profiting by kind of initiating a move. So let's say someone buys up the last available sell side liquidity here, knowing that the book's relatively thin and that you're going to get this kind of knock-on effect when price starts pushing through that illiquid area. Kind of nefarious traders will initiate that move, so they'll buy up the last available liquidity, and then they'll ladder the book up here with sell limits to exit their position. Okay, and you know, because that spike in price is essentially an anomaly, i.e., it doesn't reflect any change in value. There's been no shift in sentiment. Price will more than likely draw back to kind of fair value or a more market-driven fundamental value. Okay, so it just kind of, there's no follow through, and price kind of bleeds back into the void and settles down into the same range. And so there's an edge right there in spotting these moves and trading them back down. But I'm just going to show you some more charts now that demonstrate this behavior quite well, and which might make it easy for you to visualize what's going on. Okay. So what I've done here is I take this section of price action here, which is an hourly candlestick, and I've just zoomed into a tick chart where each bar represents 50 trades, so that you can see in detail exactly what happens on the very low time frames when price moves in this manner. Okay. So 56 chart, extremely low time frame. And you can see at the bottom here how tight the spread is, okay? It's relatively tight, probably $0.50. But as price starts moving faster and faster, okay, higher and higher, it becomes kind of more erratic. Okay, the spread starts widening, wider, wider, and it's more erratic as a result of the fact that the spread up here is really quite wide, probably around $50 as opposed to the $0.50 spread you've got down at the bottom. Okay, so that's just to illustrate what happens when price starts moving quickly, becomes more erratic, more illiquid as a result of the fact that the spread gets wide. So another example here, just to demonstrate how consistent this behavior is, and it's a behavior which you can observe on all time frames. Okay, just pull up a Bitcoin chart and look at how volatile price tends to get at tops and bottoms relative to other areas of consolidation. And you get this behavior in part because as price moves up, it takes time for buy side liquidity to build up behind price, because although some bids are kind of drawn up with price, not all are willing to chase. And so as price gets higher and higher, the book gets thinner and thinner. And so, of course, if price moves into an area of sell side liquidity after pushing up in this manner, it's quite likely that it's going to retrace that move. It will reverse. And it's this relative lack of buy side liquidity, which is referred to as a liquidity vacuum. You might have heard the phrase "nature abhors a vacuum," and it's kind of the same with price. Once the short-term frenzy slows down, as buyers dry up, price will draw back into that liquidity void which this run has left in its wake. Okay, so on exhaustion of these moves, price will very often kind of rebalance through that void until it hits some significant buy-side liquidity. And it usually doesn't take much selling for price to retrace because, as I say, there's just very little liquidity in there.
This is an example from a few months back, just so you can see what this kind of looks like in real time.
So in the middle here, you've got a basic bid-ask footprint, and I'll quickly explain what this is, but I won't go into too much detail because it's not important right now. But each of these is a 5-minute bar, okay, representative of one of these candles. And on the right, you've got market buys, and on the left, market sells. So on the right, you've got market buys, on the left, market sells. So you can see exactly how much was traded on both the bid and the ask at each price during a kind of specific time interval. And it's a tool which basically lets you see inside the bar to see exactly how it was formed or is being formed in real time. Anyway, I'll cover this in more detail later on in the program, but for now, I just want you to focus on the DOM here on the right. As price breaks these highs, okay? So as it breaks market structure, and what you'll notice is that as price starts breaking those highs, stops get triggered. And you can see this on the footprint. In a second, what you'll see is a string of zeros on the bid side. So as price starts breaking those highs, you'll see a kind of pop and a string of zeros on the bid here, on the left side of the footprint. There we go. So nothing has been sold at those levels, okay? And this happens when nothing's been sold here. And this happens when price starts moving quickly. And when you see that on the footprint, it's usually indicative of stops. Anyway, what you'll notice is that large gaps also start to appear in the order book on the bid side. The apologies for the lag here. I spent a long time trying to get a nice recording for you guys, but
Sierra's a fucking nightmare to navigate. And it turns out that I think as a result of time stamping, the market depth quantities only update once every second. So don't worry too much about the quantities, okay? What I want you to pay attention to is the spread, okay, denoted by these orange boxes.
And you'll see that as it's broken these highs, it's becoming very wide. You know, the books are starting to get extremely thin when price moves quickly like this. And so what you're seeing here is an illiquid move, a liquidity void being formed in real time. You'll also notice that price becomes quite kind of jumpy as a result of the fact that, you know, as I explained earlier, the spread's getting wider. Bids aren't repopulating the book. So what would happen if you tried to sell into that, if you'd sold at market into a move like that, is that you'd get filled at a really shitty price. And so because there are no buy limits in there when price is breaking out like that, it doesn't take much for the price to retrace fast or illiquid moves like that. I've got another view here just to kind of hammer home the point. This is the same move but on Bookmap, and the green lines here, which you can just kind of see behind the dots, that's the spread. And you can see that down here it's relatively tight, okay, and as price starts reaching for liquidity, the spread gets quite wide, okay. And this is a heat map, by the way, so the white boxes, for those of you who haven't seen one of these before, is just representative of liquidity, so limits in the book. And you can see that, you know, here the sell side is relatively thick with liquidity, but as price pushes up, there's really nothing much in here. You know, you've got this kind of algorithm which is pushing up with price, but it doesn't seem to be intending to get filled. Okay, really, because price is moving so quickly, you just got a void in here, and so price starts retracing, and it will retrace until the bids start to repopulate the book. And this is that same section of price action, but on a candlestick chart. Okay, that's the breakout, and you can see that price didn't have trouble kind of rebalancing through that area, retracing that move before it found liquidity down at the base here, and started pushing up again. You know, very often a move like this is, as I say, an overextension. It's not indicative of change in value or sentiment, and so very often you'll get a spike like that above highs and lows, some significant market structure, and that will kind of initiate that process whereby uninformed traders jump in, people stop out, market makers widen the spread or stop providing liquidity, and price will kind of overextend itself. And as a result of that overextension and the liquidity void which that overextension leaves in its wake, it's a high probability trade because price, number one, has exceeded where the market kind of thinks it should be trading, right? It's only up there because of a kind of technical event. Number two, because it's left a liquidity void in its wake, and price, well, it doesn't take much selling to fill in that void, as it were. Okay. So, you know, although spikes in price can often alert us to the presence of large orders in the market, and sometimes we can expect higher prices as a result. You know, if we're seeing bids willing to chase price, the market doesn't exist in a constant state of sentiment. Okay, so some participants, especially in the FX market, they're not even banking on direction. They just want to buy some yen, for example, for whatever reason, and they don't particularly care whether it goes up or down. So oftentimes after a run like this, price will simply, it will draw back into the area of core liquidity, or quote unquote fair value. Okay. So the point is that moves like this are often a kind of artifact of market mechanics that have very little to do with value. And that's where the edge is for me. Does that make sense? I've got another example here from January, just to demonstrate how stop loss orders can contribute to and even cause what we call price cascades, which kind of increase both the frequency and the scope of large moves, moves bigger than those predicted by the normal distribution. And it's also a great example of how these self-reinforcing kind of attributes of price behavior amplify the impact of news and other price drivers. So what I've got here is the flash crash which happened on the 2nd of January in the FX market. This is Aussie yen. And what happened here is that Apple announced that they had adjusted their sales outlook, which is of course bearish for stocks. And so people bought yen, which is a safe haven currency. So, okay, we expect Aussie yen to go down, but the news was so minor compared to the impact it had on the market. It just didn't explain this this kind of volatility. Okay, what I'm looking at here is this move here. This is a 4-hour chart, by the way. This is a massive move. So you know, the news just didn't explain the move. That's what we're looking at on this is a weekly chart now. Okay, weekly chart which goes back to around 2010. It broke kind of technical levels it hadn't seen in a decade. And the reason Aussie yen and other yen crosses crashed so hard is not because of the news, but because of the market conditions when the news was released. So number one, it was a Japanese bank holiday. Number two, it was the period of time between New York and Asia sessions. So a time when liquidity is super thin anyway. And what happened is a cluster of massive stops got triggered. Okay, stops which usually wouldn't have been an issue, but in this case, because there were no buy limits there to stop price from tanking. Okay, because liquidity was thin, you know, we got this massive move. And this is a move which has nothing to do with value. It's what you might call a kind of technical event. It's simply the result of the kind of behavior I'm trying to describe. Okay, and then of course, you know, the entire move is retraced because that move just doesn't represent fair value. It's not reflective of where Aussie yen kind of should be trading, right? It's simply an artifact of market mechanics. And it's these kind of anomalies which you want to look to trade, and which I think it's really important to kind of structure your trading around. And they're not always so extreme, but you know, this is just an example of the kind of dynamic which happens day in, day out on all time frames. And for me, this is where the edge is, because what happens after is predictable. Okay, price has overshot itself as a result of purely technical factors, and as a result, you kind of know what's going to happen. What happens after is predictable. Okay, we have an edge. Price shouldn't be down there because price has moved down so quickly. There's a liquidity void in there which sellers aren't in a hurry to fill, of course, because these are bad prices. And so price draws up. Is that clear? Okay, good. Because it's, I think it's not understanding this, which is part of the reason why traders get themselves into so much trouble. Because you might have noticed that the market has a kind of illusory quality such that when price starts running like that, people think that it's going to run on forever. And, when it starts dropping, they think or feel like it's going to drop in a straight line without any pullbacks. But in fact, as a result of the kind of order flow dynamics I've been trying to describe to you, this is Bitcoin. When price appears most bullish, it's actually most likely to start dropping. And not as a result of a level, but as a result of the way in which price comes into the level. Okay, that's illiquid. And if you don't understand this, then you're fucked basically, because the way in which price moves is everything. So apologies if I've kind of hammered on about this for a bit too long today, or if I've repeated myself, but I think that understanding this dynamic can go a really long way in helping you overcome some of the more common psychological pitfalls in trading, like like buying tops or failing to take profit at reasonable levels. And it's this understanding and the internalization of this understanding which will give you the confidence to enter at good prices at the level, rather than waiting for quote unquote confirmation before you get in. Okay, at which point, of course, the move you wanted's probably already happened. Anyway, that's more or less it for today. I hope this wasn't too kind of abstract or dry, but over the next few weeks we'll start looking at some charts and talking a bit more about how to identify liquidity and illiquidity. Where is there likely to be liquidity? Where is there not liquidity? Based on how prices moved or behaved in the past. So basically on what we've covered today. And of course, we'll also move on to how you can start deriving trade ideas from this kind of understanding of price.